Hey everybody, welcome to your weekend review for the week of Monday, January 30th, 2023. And oh, what a week it was. On Monday, MBS were down 28 basis points early. Equity futures fell on Monday along with stocks in Europe as a note of caution crept in to start the week. It's going to be punctuated by the Federal Reserve meeting. Federal Reserve officials are expected to raise rates by a quarter percentage point on Wednesday, dialing back the size of the increases for a second straight meeting after recent data suggests the central bank's aggressive campaign to slow inflation is working. Signs of earnings pressure, however, are raising concerns about the health of the economy and the outlook for equities, though that is not a big concern of the Fed for the most part. Right now, it's a tug of war going on between the markets and the Fed. The market's firmly priced in peak Fed rates of about 4.75 and rate cuts starting in November, while the Fed is fighting to convince markets that rates will actually go higher and hold there longer. The Fed has to be concerned that if market starts to rally, it'll bring more price inflation pressure because of increased economic activity. The Atlanta Fed's GDP Now estimate for Q1 is a mere 0.7. This was like 2.5 fairly recently. Note that GDP Now for estimate is significantly higher than the first estimate of Q4 GDP, about 60 basis points too high. We also get jobs on Wednesday and Friday, and the market is looking for about 175,000 job creations. So the day went on, it kind of bounced around. We ended up being down 12 basis points on the day at 101.38, which is putting us right underneath that red line, which is the Fibonacci retracement level. Sorry about that, I got a call. And very narrow range where the 25 and 50-day moving averages are converging in on each other right around 101. We also got some news. Basically, economists Jeffrey Lacker and Charles Poser penned an op-ed for the Wall Street Journal about Fed policy and inflation. They discussed the use of rules like the Taylor rule, which calculates a Fed funds target rate. Based on the inflation numbers saw in December, these rules would suggest that the Fed funds rate should be about 8% right now. So take that for what it's worth. While we only have 2 trading days left in January, unless agency mortgage bonds suffer quite the shellacking over the next 48 hours, we should see a record positive excess return for US MBS, that's easy to say, US MBS index for the month. Currently stands at 1.2%, which is far above the 0.01 return seen for this month on average this millennium, and is the 0.56 record seen in 2009. So this is basically further evidence that once the market feels like the Fed has done its course, there is room for improvement in bonds. We also got a post from our sponsor at WellThatMakesSense.com, which is a passage from Jocko Willink. Discipline can seem like it's your worst enemy, but in reality, it's your best friend. It will take care of you like nothing else. The most important discipline will put you on the path to freedom. So definitely check out these spots at our sponsor at WellThatMakesSense.com.